Welcome to the first topic, GST Introduction. I'm Garima, and over the next few weeks I'm going to break down Goods and Service Tax syllabus for CA Inter students in India. This course is for you also if you are starting a business in India and want to set up your GST properly from day one. You're already registered under GST in India but feel like you're just guessing when it comes to filing. I'm building this course step by step, no jargon, without explanation, no assuming you already know things. Today we are going to unpack the story of the Goods and Service Tax. We will look at why India desperately needed it, how its framework actually works, and most importantly, the constitutional DNA that made this one nation, one tax dream a reality. Let's dive in. Taxes. Nobody loves paying them. But if you run a business, file returns, or even just buy groceries, you need to understand them. Because here's the truth, getting it wrong can cost you thousands. Getting it right just lets you sleep better at night. First, think of direct tax. That's like income tax. The government comes directly to you and says, give me a slice of your salary. It's between you and the tax man. While indirect tax is the opposite. The government doesn't ask you directly. Instead, it hides the tax in the price of things you buy, like your coffee or your phone. Let's suppose you pay 105 rupees for a cup of coffee. The shop collects that rupees 5 as tax and sends it to the government on your behalf. You never have to write a check to the government for it. So here's the simple rule. Direct tax, you pay the government directly, while indirect tax, you pay it indirectly through the price of goods and services. Examples are sales tax, VAT, GST. Those are all indirect taxes. You pay them when you spend money, not just when you earn it. So what is GST? If you've ever bought a product or paid for a service in India after July 2017, you have definitely encountered the term GST. But what exactly is it? GST stands for Goods and Service Tax. But here's what you actually need to know. It's a single tax. It's comprehensive. It is destination-based tax. That is, tax will accrue to the state where the goods and services will be consumed and not from where it originated from. And is levied on the supply of goods and services, except on the supply of alcoholic liquor for human consumption. But before GST, we had a mess. You paid tax to the center like excise duty on manufacturing of goods and then on sale of goods to the state government in the name of value-added tax or as central sales tax when the sale was made from one state to another. Then there was also a tax on supply of services. Then there was also taxes such as entertainment tax and octroi, etc. So you paid tax to the state center, you pay tax when goods moved across borders and at multiple points. So GST took all of those and said, one tax, one nation. Now, to understand why we needed GST, we have to look at the chaos before 2017, July 2017. India was a complex patchwork of taxes. The center levied excise duty on manufacturing and service tax on services, whilst the state levied value-added tax, that is VAT on sales, plus entertainment tax, luxury tax, and octroi. And the biggest problem was the cascading effect, or simply put, tax on tax. So let's understand tax on tax with this quick example. In the old regime, imagine a manufacturer makes a bag. He needs to pay excise duty to the central government upon manufacturing the bag and at the time of its removal from its factory. When he sells it to the wholesaler, the state charges him VAT as well. But here is the catch. The wholesaler pays VAT on the price that already includes the excise duty. He can't get full credit for the excise duty paid. So he adds his margin, and when he sells to the retailer, he charges VAT again on this new total. By the time the shirt reaches you, you are paying tax on top of tax on top of tax. This made Indian goods expensive and compliance a nightmare. So in this example, you can see the total tax collected in this transaction or the tax cost in this transaction is 328 rupees approximately. Whilst under GST, as excise and VAT tax are subsumed into GST, it is one tax now. So in the sample example, let's see the tax charges. At the manufacturer stage, there is just one tax of 18% GST. Then at wholesaler stage, whole of the input GST payable to manufacturer is available as input tax credit as it's one tax, and similarly at the retailer stage as well. So if we see the total tax cost under GST comes to just 234 rupees, whilst under the old regime the total tax cost comes to 328.78 rupees. So let's now also understand one of the biggest driver of the problem in the old regime, that was non-integration of central sales tax, also called CST. So CST was levied by the central government but collected by the state government where the sale originated. This was primarily levied when there was a sale of goods from one state to another. Crucially, it was not destination-based consumption tax as GST now is, but rather it was an origin-based tax. That is, tax will go to the state government from where the movement of the goods commenced. So what was the core problem? There was no input tax credit allowed in this case. The central issue was that no input tax credit was available for the CST paid. If a business is in one state and purchased goods from another state and paid central sales tax, it could not deduct that amount from its own tax liability when it sold the goods. And this caused a ripple effect of a stranded cost. That is, it kept adding to the price of the goods at every subsequent sale, creating a cascading tax burden that was ultimately borne by the end consumer. Now let's see how. In the same example, under the old regime, now if the distributor who is in Maharashtra now sells the bag to a retailer who is now in Karnataka and not the Maharashtra as it was in the earlier example, it will have to charge central sales tax, that is CST, at the rate 2%. Now this tax, that is CST, is basically collected and retained by the originating state, that is the state from where movement of the goods commenced, that is Maharashtra in this case. It is important to note that CST was enacted by the central government, but it was levied and collected by the respective states. The distributor will get full input tax credit on the CST collected and paid by him to the Maharashtra government from the VAT he paid to the manufacturer, who was also in Maharashtra in this case, upon purchase. However, now when the retailer in Karnataka now sells these bags to the ultimate consumer, who let's suppose is also in Karnataka, the retailer will charge Karnataka VAT on the bag. However, the retailer will not get any input tax credit on the final VAT she charges from the customer and pays to the Karnataka government. This is because she had paid CST to her seller, that is distributor in this case, and the distributor in turn paid that CST collected to the Maharashtra government. So when there was an interstate transaction, you can see that the tax cost increases tremendously. So in this example, now the tax cost comes to 493.44 rupees versus if the transaction happened in the same state, then the tax cost was rupees 328.78 rupees. VAT on goods was not integrated with the service tax. Before GST, the Constitution did not permit the taxation of services by states, nor did it permit the centre to tax the sale of goods beyond the manufacturing stage. This led to two parallel legal frameworks. One, state VAT on goods. It was levied by state governments on the sale of goods. It allowed credit for VAT paid on input goods. Input goods means like raw materials, something used to prepare a final output, but not for any input service paid, and eventually service tax paid on those input services. And second point was that service tax on services. It was levied by the central government on services provided. It allowed credit for service tax paid on input services like maybe transportation, but not for VAT paid on input goods. That means any goods used to provide a service. So, for a business that manufactured goods and also provided services, or even for a pure service provider purchasing goods, this created a wall. A tax paid on one side of the wall could not be used to offset the liability on the other side, resulting in a cascading burden. If we see below example, the teacher who is the service provider is not able to claim input tax credit on the laptop, which being an input good purchased by him to deliver the teaching services. Ultimately, his teaching services or the fees became costlier due to such VAT cost forming part of his overall costs. Now, as a recap, let's discuss the deficiencies in the value-added system. So, point 1, there was multiplicity of taxes and fragmented administration and the core problem of cascading of taxes. So you paid excise on manufacturing of goods, you paid central sales tax on interstate movement of goods, you paid VAT to state government on sale of goods within the same state, plus you paid entry tax to enter the destination state. India was not a single market. It was collection of small markets with its own tax barriers. This increased logistic costs and travel time drastically. Then there was dual taxation riddle of goods versus services. Classic example is such as restaurant service, whether it should be classified as goods, that is the food you're consuming, or it should be classified as a service because you're enjoying in a proper ambience, you're enjoying the AC or the special service. So, point 3, under VAT, every state had its own tax rates and its own laws. What was exempt in one state may not be exempt in another state. Businesses spent 70% of their time in litigation, like fighting with tax authorities over the classification of good, whether it should be classified as a machine or a spare part, because the tax rate depended on such answers. This created massive uncertainty and harassment for businesses. Moreover, there was different compliances to be followed for each state, and that was also different between states as well. Since states set their own rates, businesses would cluster in states with lower taxes just to save money, not because it was economically efficient. It distorted industrial location. It encouraged tax evasion. Business would show fake invoices to avoid paying the high central sales tax on interstate movement of goods. The economy was fragmented and the government was losing revenue due to widespread evasion. These deficiencies made the VAT system a bottleneck for a growing economy like India. That is why on July 1, 2017, India launched the Goods and Service Tax, that is GST. GST fixed these issues by creating a one nation, one tax system, allowing seamless flow of goods and seamless input tax credit across the entire country. Now let's discuss the advantages of GST. 1. Benefit to economy by elimination of the cascading effect, that was tax on tax. The biggest problem before GST was the cascading effect, simply put tax on tax. Under the old regime, if a manufacturer paid tax, the wholesaler couldn't claim credit for it. So the wholesaler paid tax again on the already taxed amount. By the time it reached you, the consumer, the tax has compounded. GST solved this with a seamless input tax credit system. Now, tax is paid only on the value added at each stage, not on the total price. This makes the final product cheaper. One nation, one tax, there was uniformity. Previously, every state had its own VAT rates. A shirt might cost 5% tax in Gujarat but 12% in Karnataka. This created a compliance nightmare for businesses operating across the state lines. GST brought uniformity. Whether you are in Mumbai or Kolkata, the tax rate for the same product is the same. This simplifies business planning and creates a unified national market. Ease of doing business. Remember the alphabet soup of taxes: excise, service tax, central sales tax, VAT, luxury tax, entertainment tax. Business had to register with multiple departments, file multiple returns, and deal with multiple officers. GST subsumed all these into one single registration. Everything is now digital on the GST portal. It reduces the time spent on compliance, lower costs, and makes life easier for startups and small business owners. Increased efficiency in logistics. Earlier, a truck moving from Delhi to Mumbai would wait for hours at state borders just to pay octroi or entry tax. This wasted time, fuel, and money. Under GST, checkposts at state borders have been dismantled. This has reduced travel time drastically. Experts estimate that logistic costs in India dropped by quite a percent after GST implementation. Faster movement of goods means lower cost for the end consumer. Because GST offers input tax credit, business wants to buy from GST registered suppliers. Why? Because if you buy from an unregistered dealer, you might not claim the credit. This incentives businesses to come under the formal economy. It brings transparency, widens the tax base, and reduces black money circulation in the supply chain. Now let's discuss about the taxes subsumed in GST. Note that this is very important for your examination purposes. Because in the past CA examination, we have seen a lot of questions from this area where the questions were such as list any 6 state tax that were subsumed in the GST regime, or list any 6 central taxes that were subsumed in the GST regime. So let's discuss the central taxes first. Central taxes as in the taxes which were levied by the central government. First was the central excise duty. That was an old way of taxing on manufacturing of goods. Now in GST, now this has become part of the central goods and service tax, or CGST, where manufacturers get credit for the tax paid on inputs. Now, then there was service tax, which was also levied by the central government on taxing for services like software, dining out, cab rides. But in GST, now it's part of the CGST, or the Central Goods and Service Tax, for intrastate services, and IGST, or integrated GST, for interstate services. Now then there is additional duties of customs, that is countervailing duty and special countervailing duty. In the olden regime, it was an extra tax on imported goods to level the playing field with the local manufacturers. In GST, it has been subsumed into integrated GST for imports. Surcharges and cesses, most central cesses were subsumed except a few like the GST compensation cess on luxury or demerit goods, which still exists. And there is one important point you should note on central sales tax. In the case of interstate sales, the center or the central government had the power to levy a tax, that is the central sales tax. But the tax was collected and retained entirely by the states, from where the movement of the goods started. Now let's discuss about the state taxes that were subsumed in GST. First was VAT and sales tax. In the old way, the biggest source of state revenue, the tax on sale of goods. Every state had different rates. Some states had 14.5%, some had 12.5%. So it depended state on state. In GST, it was all eliminated. Now, state GST on all intrastate sales are applicable. Then, entry tax or octroi. Old way, a massive headache for business. Tax paid just for bringing goods into a city or state. Example, trucks were stuck at border checkposts. So in GST, it was all abolished. In GST, goods moved freely across borders without tax barriers. Luxury tax, in the old way, there was tax on hotels, spas. But in GST, it was all subsumed. Now hotels fall under the GST slab rates. Entertainment tax, the ones which was charged by the state governments, these were all subsumed. There was tax on movie tickets, amusement parks. Now purchase tax. In the old way, purchase tax is a state level levy on specific goods purchased from non-VAT dealers or used in non-taxable ways, generally ranging between 1% to 4%. It is distinct from sales tax as it is imposed on the buyer rather than the seller. In India, it covers items like food grains, raw materials, minerals, etc., etc. So in GST, it was all subsumed. Then state cesses and surcharges. In old way, various small taxes was levied by the states, but now it's mostly subsumed. Now, tax is not subsumed in GST. This is also another important topic for exams where questions frequently come as to which are the taxes which has not been subsumed in GST. So first is this basic customs duty, which was there in the previous regime and still exists. When the goods enter India, then we have to pay this basic customs duty. Then entertainment tax levied by the local bodies has still not been subsumed. Earlier, the entertainment tax levied by the state government has been subsumed, but not the ones levied by the local bodies. Then property tax and stamp duty, electricity duty. Then duties such as state excise duty and VAT on alcoholic liquor for human consumption. It's still there. Based on the current definition of GST, GST is applicable on supply of all goods and services except for alcoholic liquor for human consumption. So any state excise duty and VAT and CST on this alcoholic liquor for human consumption, it is still there. Then duties or central excise, VAT, CST on motor spirit or petrol, diesel, natural gas, aviation turbine fuel and petroleum crude, these 5 types of fuels are still there. Currently, no GST is levied on petrol, diesel, natural gas, aviation turbine fuel and petroleum crude, and the GST Council shall recommend a date on when GST will be levied on them. Another point which is very important to note that duties on alcoholic liquor for human consumption was state excise duties. It was always under the purview of state governments in the old regime and as well as now, because alcoholic liquor for human consumption is completely outside the purview of GST because it does not even come under the definition of GST. Whilst these 5 petroleum products like motor spirit, diesel, natural gas, aviation turbine fuel, petroleum crude, previously it was always levied, the duties were always levied by the central government. So it was always central excise duty, and it was not coming under the purview of state governments, which is currently also the case. And whilst these 5 fuels do come under the purview of GST, but till now, any GST rate has not yet been recommended on them. Another important points to note for your exams are first, tax on tobacco. It is subject to GST and central excise duty. Here, the union government has also retained the power to levy excise duties on tobacco and tobacco products manufactured in India. So, it is tobacco and its products are subject to GST as well as central excise duty. Again, tax on opium, Indian hemp and other narcotic drugs and narcotics, it is subject to GST as well as state excise duties. So here the state governments have retained the power to levy excise duty on such products manufactured in India. So resultantly, it is subject to GST as well as state excise duties. Other important point to note is that real estate has been kept out of GST. However, GST is applicable on under construction properties in India currently and not on the completed properties. Now let's discuss genesis of GST in India. By genesis, we mean the origin. So the idea of GST wasn't born in 2017. It was actually conceptualized much earlier. So in the year 2000, the then Prime Minister, Mr. Atal Bihari Vajpayee, he mooted the concept of GST and set up a committee to design the GST model for the country. In year 2003, the central government formed a task force, which in 2004 strongly recommended fully integrated GST on a national basis. So what do you mean by fully integrated GST on a national basis? Basically, the task force meant that the GST should subsume multiple taxes. That means a single comprehensive GST that replaces numerous central and state taxes such as excise, service tax, VAT, etc. And there should be seamless input tax credit flow. So ensuring that the credit for tax at each stage of the value chain is passed on, reducing the cascading effect. And most importantly, the dual model, a system where the center and the states concurrently levy tax on a common base. that is central GST and state GST, while maintaining a uniform structure. So that's what they meant by fully integrated GST on a national basis. Then moving on, the Union Finance Minister, Shri P. Chidambaram, while presenting the Union budget in the year 2006 and 2007, announced that GST would be introduced from 1st April 2010. But since then, GST met several deadlines and continued to be shrouded by the clouds of uncertainty. Why was that? There was a big hurdle, the Constitution Amendment Bill. Why was it difficult? I'll discuss in the later part of the video in great detail what were these challenges, but just to give you a crux, because GST meant taking away the state's power to tax sales, that was the VAT, and giving it to a concurrent authority. States were afraid of losing their financial autonomy. So in the year 2014, when the Modi government or the NDA government, which came in huge majority, took charge, the GST gained momentum and tabled the constitution of GST in the parliament on 19 December 2014. The Lok Sabha passed the bill on 6th May 2015 and Rajya Sabha on 3rd August 2016, one year later. Subsequent to ratification of the bill by more than 50% of the states, the Constitution 122nd Amendment Bill 2014 received the assent of the President on 8 September 2016 and became the Constitution 101st Amendment Act 2016, which paved the way for introduction of GST in India. In the following year, on 27 March 2017, the central GST legislation such as Central Goods and Service Tax Bill, Integrated Goods and Service Tax Bill, Union Territory Goods and Service Tax Bill, and Goods and Service Tax Compensation to States Bill were introduced in the Lok Sabha. Lok Sabha passed these bills and the President's assent was received on 12th April 2017. The bills were enacted. Simultaneously, the enactment of the central acts was followed by the enactment of the state GST laws by the various state legislatures. So by 30th June 2017, all states and union territories had passed the respective SGST and UT-GST acts, except for Jammu and Kashmir. After 8 days, that is Jammu and Kashmir on 8 July 2017, it was the first time in 70 years after independence that India truly became a common market. Now, before going to the next topic, let's discuss a question that seemed very simple but often creates a lot of confusion, both in exams and in practical life. The question is, how many states does India have for GST purposes? Note, for GST purposes. Now let's understand the answer. As per Article 1 of the Constitution, India is a union of states. However, GST is a destination-based consumption tax. This means that the tax is collected by the state where the goods or services are consumed. Now to implement this, we have a federal structure. Many students think India has 28 states and 8 union territories. So is the count for the GST the same? Not exactly. As per the Constitution, GST is a federal union of 28 states and 8 union territories, that is UTs, totaling to 36 subnational entities. Now, states have their own elected governments, while UTs are governed by the union or the central government. However, 3 union territories have their own legislatures and are treated as states for GST purposes. Note, this is important. Out of all the union territories, there are 3 union territories which have their own legislatures and they are treated as states for GST purposes. Which are those? Delhi, Puducherry and Jammu and Kashmir. Why? Because they have their own legislatures. So if you add these 28 states as per the Constitution plus 3 union territories with legislatures, there is 31 states for GST purposes. Now, we are left with the union territories without legislatures. These are the areas directly governed by the central government. Each of these is considered a separate jurisdiction. They are 1. Andaman and Nicobar Islands, 2. Chandigarh, 3. Dadra and Nagar Haveli and Daman and Diu. This is all counted as one jurisdiction. And 4th, Lakshadweep, and 5th, Ladakh. This gives us a total of 5 union territories for GST purposes. So, only for GST purposes, we have 31 states, that is 28 states as per the constitution, plus 3 union territories with legislature, that is Delhi, Puducherry and Jammu and Kashmir, and 5 union territories without legislatures. Now, what was the framework of GST as introduced in India? Here, what make Indian GST unique? Because India is a federal structure, we have both the central government and the state governments. We don't have just one GST, we have 4 different types. First is the CGST, that is the Central Goods and Service Tax. It is collected by the central government on intrastate sales, that is sales within the same state. SGST, that is State Goods and Service Tax. It is collected by the state governments, that is the 28 states and the 3 union territories with their own legislatures, on the same intrastate sales, that is the sale within the same state. So when there is an intrastate sale, both CGST and SGST will apply, and it is divided equally between CGST and SGST, the rate of GST. Then third is IGST, that is the integrated GST. It is collected by the center on interstate sales, that is when goods move from one state to another. And then fourth is UTGST, that is Union Territory GST. It is same as SGST, but for union territories without their own legislatures like Chandigarh or Ladakh. Now let's understand the GST structure with the help of these examples. That means where to use CGST and SGST, and where to use IGST, where to use UTGST. So we'll see different scenarios here. So let's suppose 1,000 rupees sale happens within Maharashtra. That means within the buyer and the seller is both in Maharashtra. So when a sale happens, in this case, the invoice will show CGST as well as SGST. So let's say take the GST rate here is 18%. So it will be equally divided between CGST and SGST, that is 99%. So if the price is 1,000 rupees, then 90 rupees is the CGST and 90 rupees is the SGST, equally divided. And then the total price comes to 1,180 rupees. Now versus when there is a sale outside the state, that means from Maharashtra to Karnataka. Then if the price is rupees 1,000, then only IGST will be applicable at the rate of 18%. So the total is 180 rupees, and then the grand total will be 1,000 rupees, 180. So the price is all same, but the GST, what type of GST will be applicable? In case of intrastate sales, it will be IGST. While if there is within the same state sale, then it will be CGST and SGST. Now where does UTGST apply? So when there is a sale within Delhi, let's suppose there is a sale within Delhi which is a union territory, but it is a union territory with its own legislature. So here again, when the price is rupees 1,000 rupees, then CGST will apply at 9%, that is 90 rupees. Let's suppose the GST rate of this good is 18%. And in this case, SGST, again, because a union territory with its own legislature is considered as a state for GST purposes, SGST will apply here at the rate of 9%, that is 90 rupees again. And then the total price of the goods comes to 1,180 rupees. Now, when there is a sale within Ladakh, that is a union territory without its own legislature. So if it is within that union territory, that is Ladakh to Ladakh, both the buyer and seller is in Ladakh, then the price will be 1,000 rupees. Again, let's suppose the GST rate as such is 18%, then it will be equally divided between the central GST and the UT GST. Here, UT GST will apply. So, in this case, as CGST will be 9% at the rate of 90 rupees, the total comes, and then UT GST is again at 9% and 90 rupees will come. So, total price of the goods again in this case is 1180 rupees. Now, when there is a sale from Ladakh to Delhi, let's suppose it is an interstate sale. Now, here the price will be 1000 rupees, but for any interstate sale, it will be IGST at the rate of 18%, that is 180, and then again the total comes to 1180 rupees. In continuation to the story of GST, let's discuss how did the Parliament get the power to make GST law in the first place, and what were the challenges involved? The answer lies in Article 246 of the Constitution of India. Let's break it down. Article 246 is the backbone of our federal structure. It tells us that Parliament, central government, and the state legislatures have exclusive powers to make laws on subject mentioned in 3 lists of the 7th schedule. List 1, that is Union list. Only Parliament can legislate here. That is defence, income tax, customs duty. List 2, state list. Only state legislatures can legislate here, like police, agriculture, sales tax, VAT, entry tax, betting. List 3, concurrent list. Both can legislate, like stamp duty. Now, before GST, the taxation landscape was a mess. The centre taxed manufacture via excise and services via service tax, while states tax sale of goods via VAT, entry tax. The problem, there was no power for centre to tax sale of goods beyond the manufacturing stage and no power for states to tax services. This led to the infamous cascading effect, tax on tax. The goods and service tax was not introduced into the concurrent list 3 of the 7th schedule because that framework was inadequate for a dual tax model that requires simultaneous equal taxation powers for both union and states on the same transaction. Weakness of the concurrent lists. Under Article 254(1) of the Constitution, if there is an inconsistency between a law passed by Parliament and a law passed by a state legislature on a subject in the concurrent list, the central law prevails. This would have violated the federal spirit of the GST, where states needed to have an equal say, not a subordinate one. Then, dual GST model requirement. GST is designed as a destination-based consumption tax consisting of 2 parts, central GST and state GST, imposed simultaneously on the same base. The traditional concurrent list structure did not provide for this specific type of concurrent parallel taxation on the same transaction, but rather for overlapping legislative areas where one often overrides the other. Need to override Article 246. Before the 101st Amendment, Article 246 gave the centre exclusive power to tax services and manufacturing, while states had exclusive power to tax the sale of goods. Simply adding GST to the concurrent list would not have automatically removed these existing rigid limitations. Instead, a unique solution was chosen, introducing Article 246A via the 101st Constitutional Amendment Act 2016, which grants special powers to both Parliament and state legislatures to legislate on GST. To implement GST, we didn't just pass a new law, we amended the Constitution. The 101st Constitutional Amendment Act 2016 fundamentally altered Article 246 and the 7th schedule. The newly inserted Article 246A is unique because it overrides Article 246 and 254, allowing both the Parliament and state legislatures to pass their own GST laws concurrently preserving the federal balance. Now let's discuss the birth of Article 246A. To unify this, the Constitution 101st Amendment Act 2016 inserted Article 246A. This article, it's a non-obstante clause, meaning it overrides the general distribution of powers under Article 246. Let's read it in two parts. Clause 1, that is, notwithstanding anything contained in Article 246 and 254, Parliament and, subject to Clause 2, the legislature of every state have power to make laws with respect to goods and service tax imposed by the Union or by such state. What does this mean? Number 1, notwithstanding. Let's harp on this word notwithstanding. It means regardless of the Union list or state list, both Parliament and state legislatures now have the simultaneous power called concurrent power to make laws on GST. This is the concept of one nation, one tax. Both governments can levy tax on the same transaction, that is, on the same supply of goods or services. Now moving to Clause 2, Parliament has exclusive power to make laws with respect to goods and service tax where the supply of goods or of services or both takes place in the course of interstate trade or commerce. Intrastate supply, that is within a same state, when the movement of goods or supply of service happens within the same state. Both the central and the state governments can make laws. And what is the result in such a case? CGST and SGST is applicable on such a transaction. But what happens in case of interstate supply, that is movement of goods or supply of services between states, that means from one state to another? Only Parliament, that is the central government, has the power to make laws in such a case. And the result is IGST, that is integrated GST. The states do not have jurisdiction over interstate trade. Note that this amount will be apportioned between the Union and states in the manner provided by the Parliament by law and as per the recommendation of the GST Council. And the Parliament shall also determine the principles on the place of supply and when a supply takes place in the course of interstate trade or commerce. So, to sum it up, Article 246A is the constitutional engine of GST. It broke the old barriers of union and state lists and created a new unified field of legislation. It allows the center to tax intra-state supply alongside states while reserving the exclusive power over interstate trade to the center. Constitution 101st Amendment Act 2016, or rather abbreviated as CAA 2016. Let's discuss some of the significant provisions under it. First, let's understand CAA 2016. It is basically the bedrock of GST in India, fundamentally restructuring the tax powers between the center and the states. The foremost, the new constitutional framework under Article 246A was the major provision which was introduced via CAA 2016. And we have already discussed it in detail in the previous section. Other significant provisions include one is the definition of GST under Article 366(12)(a). GST is a tax on supply of goods or services excluding alcoholic liquor for human consumption. So, alcoholic liquor for human consumption is permanently out of the scope of GST because of the definition of GST. Apart from that, other provisions under CAA 2016 are, it has also kept 5 petroleum products, that is crude, petrol, diesel, ATF, natural gas out of GST, but temporarily. It has to be included on a future date by the recommendation of the GST Council. Apart from that, central government has power to levy excise duty in addition to GST on tobacco products. These we have already discussed in the previous sections. Apart from that, other significant provision under CA 2016 is the formation of the GST Council, and the details are laid down under Article 279A. The Constitution empowers the President to constitute a joint forum, namely GST Council. GST required a mechanism where the centre and state governments could decide tax rates together. We will discuss in detail on this subsequently. Then moving on, interstate tax and revenue sharing under Article 269A. So just an overview, what it does, it empowers the central government to levy and collect IGST, that is the integrated GST, on all interstate supplies and imports. Why it matters? The revenue is then split between center and the destination state where the goods or the services are consumed, ensuring the consuming state gets the tax. We will discuss this in more detail subsequently. Then apart from that, it's the compensation to states. So initially when GST was launched and before it was getting launched, the states were fearing of losing their revenue because GST replaced their powers to tax items like VAT and entry tax. So what it does, it provides a constitutional guarantee to compensate states for 100% of revenue losses for a transition period of 5 years, originally from 2017 to 2022. And so why it matters? This assurance was the political glue that convinced all states to ratify the amendment and give up their taxing powers. Now let's discuss a very important topic, especially for your exams. This is the Article 279A, that is the article relating to the GST Council. So what is Article 279A? Article 279A was inserted into the Constitution via the 101st Amendment Act 2016. It mandated the President to constitute the GST Council within 60 days of the Act's commencement, effectively making it a constitutional body. The provisions relating to GST Council came into force on 12 September 2016, and the President constituted the GST Council on 15 September 2016. So now let's discuss about the composition and seating arrangement as well as their voting weightage of the GST Council. So this is a joint forum of the centre and states, whereby it is headed by the Union Finance Minister, who is also called as the chairperson of this council. And members include the Union Minister of State in charge of revenue or finance, the minister in charge of finance or taxation, or any other minister nominated by each state government, any person nominated by the governor of the state where there is a proclamation of emergency under Article 356 of the Constitution of India. Now let's discuss about the voting power. The centre holds 1/3 weightage while all states collectively hold 2/3 weightage. And what is the passing majority? Decisions require 3/4 majority of the weighted votes. What is the quorum of GST Council? Half of the total members of the GST Council is the quorum. So now let's discuss what's the scope of their work, or what are the scope recommendations. The council recommends on basically all matters related to GST as per the Article 279A, but key area includes taxes, cesses and surcharges to be subsumed, exemptions and threshold limit for turnover, floor rates with bands of GST and special rates for calamities, model GST laws and place of supply rules, and also provisions in relation to special provisions in relation to states of Arunachal Pradesh, Assam, Jammu and Kashmir, Manipur, Meghalaya, Mizoram, Nagaland, Sikkim, Tripura, Himachal Pradesh and Uttarakhand, and such states are also referred as special category states in GST. So they make special provisions in relation to these states, basic key areas of GST Council's recommendations. It is also important to know that no act or proceeding shall be invalid, or any recommendation will be invalid merely by reasons of any vacancy or defect in the constitution of council, defect in appointment of person as a member of the council, or any procedural irregularities of the council not affecting the merits of the case. So we did see some question back in the past papers relating to this topic as well. Article 269A. Basically, Article 269A provides the constitutional backbone for the integrated goods and service tax. It mandates that only the government of India, that is the central government, has the authority to levy and collect tax on interstate supplies, that is where the movement of goods or services happen from one state to another. This tax collected is called the IGST, or the Integrated Goods and Service Tax. So what are the key provisions under this article? First is the revenue sharing, that is the apportionment. While the center collects IGST, the money does not belong solely to the center. Article 269A states that the tax collected shall be apportioned between the union and the states. So for example, if the good is sold from Maharashtra to Delhi, the seller that is in the Maharashtra, he will collect IGST from the customer in Delhi and pay that IGST to the central government. Now, in turn, the customer uses those goods that he purchased from the Maharashtra seller and as a raw material to prepare a finished goods at his end. Now, he will claim input tax credit on such IGST that he paid to the seller while he invoiced it to the Delhi person. So, as per the revenue sharing arrangement, the central government apportions the IGST amount to the destination state, that is the Delhi. So, this is the destination principle. Unlike the old VAT system, which was origin based, under Article 269A, the tax revenue goes to the consuming state, not the manufacturing state. Other important provision provided under this article was imports are deemed as interstate. So basically this article states that the supply of goods and services imported into India shall be deemed to be a supply in the course of interstate trade or commerce. But why does it matter? It actually allows the central government to levy IGST on imports. And why is this? Because imports are deemed interstate, so IGST is levied along with the customs duty, that is the BCD. This ensures imports are taxed at par with the domestic goods and to form a level playing field with the local manufacturers. Another key provision was the power to make rules, that is place of supply. So this article also gives Parliament the exclusive authority to formulate principles for determining when a supply qualifies as interstate versus intrastate. And it allowed the Parliament to legislate on stateless subjects during specific situations. So this 2016 amendment also added goods and service tax provided under Article 246A to both these articles as well. So why was this amendment necessary? Article 246A already gave Parliament and states simultaneous power to make GST laws. However, the drafters wanted to ensure that in extraordinary circumstances, Parliament's emergency power would explicitly cover GST matters without any legal gap. So what is Article 249? It basically relates to this national interest power. So what is the original provision? The Parliament can legislate on the stateless matter of the Council of States. What is called a Council of States? It's basically Rajya Sabha, which passes a resolution supported by 2/3 of the members present and voting, declaring it necessary in national interest. What this means for GST? So if the Rajya Sabha passes a national interest resolution, Parliament can make laws on any aspect of GST that normally falls within the state jurisdiction. This resolution route under Article 249 has never been used for GST since its introduction in 2017. The GST Council's collaborative mechanism has been sufficient so far. Then there is one more article, that is Article 250. This is used under emergency proclamation power. So original provision was, while a proclamation of emergency is in operation, Parliament can legislate on any state list matter for the whole or any part of India. But what this means for GST? During a national emergency, Parliament can make any GST law without state legislatures' participation. The law ceases to have effect 6 months after emergency proclamation ends, except for things already done. Note that this is a temporary power, not a permanent takeover of state GST authority. So the states usually regain the legislative power once normalcy return, and this is a very rare circumstance. Usually those emergency proclamation power and all are not very exercised very frequently often. Based on the past 6 attempts, the questions from the first topic is between 0 to 3 marks. Nonetheless, it is very essential to understand what GST actually is and much more. So it's simple, right? Now you have to know the difference. If this has helped, hit that like button and subscribe. See you in the next one.